Clint, your last example looked at a 20-year time period. Let's just go back not too terribly long ago to April of 2025.
Yeah, so when we think back to April of 2025, we remember that the tariffs are really starting April 1st. Those announcements are made, and there's a really significant drop in the market. And if you just fast forward from April 1st, go out about a week, the market has kind of been in a free fall type of situation. And the news, if you were to read the news headlines, says things like, hopes wane for tariff concessions. There's stock carnage is what the Wall Street Journal was saying. Stocks in turmoil. A lot of people say these tariffs won't be resolved overnight. And then what you're finding is in that first week of April, you are inching closer to realizing a full bear market. A bear market is when you're down 20% in the market, and right around that April 8th date, you're at 19%. So a lot of people are saying the bear market is here. We can just expect and anticipate that is what the future outlook is going to be. And what you'd find is that not a lot of people were excited probably that day, and some people were probably thinking about doing things. This is just going to be a continued free fall. This isn't going to be resolved soon. Maybe it makes sense to go to cash, get out of the market. And we've talked many times about, studies out there show that's not a good idea, but you could easily see how someone could be in that mind frame on April 8th. And if they did that, what they would miss is April 9th. And when we look at April 9th, we see that that was one of the best trading days since 2008. During that time, the Dow went up almost 8%. The S&P was up 9.5% in a single day, and the NASDAQ that day was up 12.2%. And so what you'd find is if you were to make rash decisions on April 8th, which is not unbelievable to expect that someone might be in that area, especially if they're nearing retirement saying, I want to stop the bleeding. But then they would have missed April 9th, which goes to just underscore in a more recent example, that's 20-year study that we looked at, which is you need to stay in for the longer period of time and be proactive as you think about your investment strategies.
And that's why I said market volatility is actually very predictable. Sometimes what we hear, Clint, from people that we're talking about is, yeah, but this time it's different. Yeah, this time just feels different. And yes, every time we go through a market correction or a bear market, we go through it for a little bit different reason. But the one thing that is constant is eventually the market's going to come back like it always has. And as long as you make the right moves during this time frame of volatility, you can benefit from the market volatility. And eventually when the market does come back, you are going to be able to prosper from that movement as well. The hardest part about all of this is just going through the uncertainty, because when we go through those time frames, the time frames that we talked about, COVID, 9/11, Black Monday, 1987, all of those time frames are not fun, right? We don't enjoy the pain, but just from a financial standpoint, it's actually a time to smile because of the opportunities that are present and how it can really positively impact your overall retirement plan.